Right. Okay. Well, it was very good done anyhow. Talking about presenting it to investors, many of the entrepreneurs would perhaps be slightly overly optimistic when presenting their business plan, which may lead to that they would not meet their targets, or that the availability of capital may be the only way to meet their targets. And Paul, having done several investments here, would you say that you would rather invest more than that they expect to secure the targets, or would you be looking at their plan and make the conclusion that this is probably overly optimistic, so I will be more conservative and invest less?
First of all, there's nothing wrong with optimistic entrepreneur.
No.
I mean, especially today, you need to be optimistic to become an entrepreneur, to start a business. So we don't have any problem with optimism. On the other hand, what's also very important to us is that we have a management team in place which has a good feeling about market traction, about the status of their technology development. So promising too much or over-promising is not good in the end. For us, this is one of a major evaluation point, because resource allocation in an early stage company, meaning putting the focus, the money and the minds on the best opportunities, is a major point in growing a business. So for any management team which where we have a lot of confidence in, we are willing to put in the money which is needed to build that business. This does not mean that we will copy some practices which we see in the US market, for instance, where they do very big rounds. I think innovation, or bringing innovation into commercialization, has not always to do with the amount of dollars. I think it's also how you spend the dollars, and honestly, I think in Europe we have a better tradition in putting money at work at the right focus. Where we lack is the execution, and there we can learn a lot from the US market. But in general, we are willing to support those companies with a little bit more than what we normally calculate, if you have a good feeling in how they assess the market, how they drive the company forward. So for good companies, I don't think there's an issue for money. It's those companies which fail in their milestones where there are a lot of discussions.
How active do you become in the company then, if you see that they're not perfectly meeting targets? Would you be more involved and forcing them to meet targets and perhaps do minor modifications to their plan?
Well, first of all, we don't want to be the CEO of the company. That's one. We want to work with professional CEOs. That's one. Secondly, there are some things, and this difference from company to company, where we as an investor put more focus on, and where we go a little bit further than just being a board member. For instance, those things which has a very important value-enhancing value for the company, there we try to follow everything in detail. If we invest in companies like industrial biotech, we've put a lot of focus on understanding the process and the challenges. So in order to have a good understanding, especially for any following on round which is following, we have to understand the risks and the challenges which are in front of us, and I think it's one of our duties to build up that knowledge. On the other hand, I think on the other hand you have to be always very careful not to interfere too much with management issues, and but in an early stage company the line is always very thin, and a company which is already with a very good management team and a little bit more advanced, we try to just keep our role to board membership.
Eric, you mentioned that you wanted to make the funding in the way that you maintain control of your company, which is understandable. But would you see that you only asked for sort of financial capital or smart capital with resources attached? How was your evaluation and the action you made thereafter?
Yeah, I think it depends on the company how you should think there. And for us, our president, he was former president of a daughter company in the US, and we have a sales vice president that also been president of a daughter company in Asia, and also worldwide sales and marketing responsible in that area. So we didn't feel that we wanted management experience from the investors that we sought for, but still after when we had gathered the team that became the founders of the company, still of course you have to look and see where are we lacking in experience and where are we lacking in knowledge. And we found some technical parts where we needed to strengthen the team, so we looked for senior scientists and got some of them into the team. And then we also felt that we didn't have the legal expertise that we wanted to have, and that we got from the investors. So in that sense, we got the smart money that we needed and we wanted. But I think you need to be careful as an entrepreneur, because both VCs and angel investors, they always come and say, I can help you with this, and we know this, and we know this. But you have to think about, is this really what I need, or is it what they know?
Yeah.
And usually, I think we were a little bit different team compared to a normal startup, that we did not come from R&D background, most of us. We were mostly from building machinery and selling. And actually, when we started the company, I was working in Japan, and one other founder was in Thailand, and the third founder was in US.
Yeah.
And only one of us was in Sweden. So I think you have to look at the strength of the team and decide from there.
So you defined what kind of skills and resources you needed, and then sought capital based on that?
Yeah, so actually we had a couple of, we talked to different investors, and one of the strengths with the team that we chose to work with, or the it's actually one or two quite, it's still angel investments, but I think compared to VCs, they are probably as strong and has as deep pockets. So in that sense, we have not had the problems that you described, that we need to get money every third month. Actually, our last round was in 2006, and we're still living on that money. So, and we have also been lucky that we always have been able to get good money, in the sense that we have raised money because we have achieved something, or that we have received a grant that we need to counterfinance. We have never ran out of money and needed money for that reason.
No,
so I think
that's true.
It also makes a difference.
So you were defining what you needed, and Mike, from your perspective, you're doing the opposite. You have the money and you define what you're looking for. And what would be the main criteria you would be sort of verifying when you approach or evaluate a opportunity?
Sure. So I mean, the group that I'm involved with, the Clean Tech Circle, I mean, we initially get involved with companies really just using our time to help the companies out. So we don't really see ourselves as sort of an angel investment group first. We usually find companies at a very early stage, 1, 2, 3 people, pre-funding.
Yeah.
Obviously, the idea in the market has to be very compelling. We have to like the team because we're going to spend a lot of time working with them. It's okay if the team doesn't have the long-term sort of management capability. It's more important that they're realistic about what their role is going to be. If they have a great first-time CEO that's coachable, we'd love to work with them. On the other hand, if the entrepreneur is not going to be the long-term CEO, then hopefully they're willing to sort of create another role for themselves, be it CTO or whatever it happens to be. So a lot of times we'll spend easily a few months working with these companies, just gratis, just getting to know them, helping them out, and developing a relationship. And after a while, you get a read for, are these people we can work with and want to work with us? And then if so, we'll try to then do a longer-term engagement with them. And it's probably more the rare case where we're going to write a check for these companies. I mean, hopefully the company is compelling enough after they've gone 6 months or so, they can raise money on their own. One thing we've seen sort of recently is that I think because of the economic situation, a lot of angels have pulled back, so it's a little harder to get those sort of $250K investments. But a lot of companies we're seeing are able to get a VC round. So actually, right now, there's like 3 companies we're working with that I think are all going to get sort of their Series A funding. It probably means they're giving up more of the company than they would have liked, because you're going to give up more than if you did an angel round. But I think for all these companies, there should be enough money that they should be able to buy, 18 months, 2 years at a time. I think a lot of the problems raising VC money is, you have the money, so you tend to spend it. So I think is if you can have the discipline to stretch it out, then I think it could work out really well. Maybe don't focus so much on saving every little percentage when negotiating the deal. Maybe focus on how you're going to execute the next 2 years to make sure you get as much value as you can out of that money.
Yeah, yeah. No, discipline is obviously